I don't talk about it often on this channel, but I actually went to university for all of this financial mumbo jumbo. I have a master's in financial analysis and investment management, and a lot of the things that I learned in that studies is pretty much useless. The more you study the theory, the more you understand how much it is completely irrelevant and detached from reality. For example, how should we value an investment? The super basic stuff. The basic principle is that the fair value of an investment is equal to the sum of the future cash flows discounted to the present future. What does it mean? It means that if we look at a cash flow, say in 30 years, that cash flow should be worth less to us today compared to a cash flow that comes tomorrow. So we have to discount future cash flows. We have to sum up what kind of money can we expect in the future. And the further it's out in the future, the less it's worth to us. And also the more we have to discount that future cash flow, the less it's worth to us as well. So that is the basic fundamental idea. We've got, say, $1,000 cash flows for the next 30 years. And that could be an apartment. That could be a very stable stock that does not increase its dividends. It could also be a bond. A bond is probably the best example because over there we've got 100% guaranteed. Let's say it's a US bond that will get that money. And we also know what kind of money we can expect, right? We've got the fixed coupon payments. And so the sum is not just, say, $30,000. The sum of the cash flows is less, as in the present value of that bond is less because we have to discount. And we do this by more and more every year. So the first cash flow 1 year from now has to be discounted by 6.8%. The second one by 1.068 to the power of 2 and to the power of 3 to the power of 4, etc. You get the idea, right? This is the idea of discounting future cash flow. Sounds all logical, right? And that then also explains various things. That explains, for example, why people say when interest rates go down, then in theory asset prices across the board should go up, right? Houses should go up because, of course, also mortgages get cheaper, but even stocks should go up because the discounting is less. Bonds should go up, all of that, right? There is an inverse correlation between interest rates and prices. Interest rates go down, prices go up, and vice versa. Interest rates go up, prices should go down. And so let's test this theory, right? Because everybody talks about this also in crypto, right? In crypto, everybody says if there's only monetary expansion, if only the Fed balance sheet is going to go up, if only interest rates are coming further down, then all the risk on assets will go up in price, especially Bitcoin and the altcoins, etc. But let's start off with the super basics, right? When we know the future cash flows, as with a coupon, right? When we know the future cash flows with a US government bond, do we actually see this connection? Have a look at this here. At the top, we've got TLT. This is a long-term government bond ETF. So it's an exchange-traded fund that invests into long-term government bonds, US bonds only. And the price, of course, fluctuates over time, apparently depending on the interest rate expectations. But have a look at what we see here at the bottom. This is actually the target interest rate. We had a lot of monetary tightening after the dot-com bubble crash in 2004 and 2005. And then we had the global financial crisis, which brought the interest rates to zero. Then we had a bit of tightening again, then again a move back to close to zero, another tightening. Now we tend to go down. Now, do we really see a connection between the prices and the interest rates? So for example, over here, right, the interest rates went from 1% all the way up to 5.25%. Let's bring out our calculator, our 30-year treasury bond. With a discount rate of 1%, the net present value of the future cash flows is 26K. This is how much our imaginary bond should be worth. If now interest rates go up to 5.25%, then the net present value of our bonds should go down to $15,728. A huge drop. Do we see any kind of price movement like this in the long-term government bond ETF during the monetary tightening or the subsequent loosening of monetary policy? We don't see it. Isn't that fascinating, right? Prices should be fluctuating by 30-40% on bonds where we definitely know the future cash flows, but we don't see it. And we also can't pretend that the market was so wise that it already anticipated the interest rates, say 5 years out in the future. That's normally not how it works, right? When we look at the futures market, we can see how interest rate expectations also fluctuate quite a bit. So isn't that kind of crazy, right? A very basic mechanism in academia for finance, discounting future cash flows. The present value of future cash flows should determine the current fair value of an investment, that we can't see this actually in the price data. Isn't that incredibly fascinating? We then had monetary tightening in 2015 up until 2019. And what happened to the long-term government bond prices? They went slightly up, right? When interest rates go from 0 to 2.5%, prices should not go up. From a 30,000 net present value, we should be going down to 21,454. We should lose roughly a third of our long-term government bonds in terms of value. We didn't lose a third, we went up by 10%. And even if the market was that wise to anticipate that tightening ahead of time, still, right? Even if we bought a bit earlier, the effect is even more pronounced. The only case one could make that this model works is just with the recent tightening, where bond prices indeed went down, and that was by 42%, and we moved from 0 interest rates pretty much to 5.5. In theory, we should drop by even 50% roughly, right, from 30k to 15k, but still I give that a pass. That makes sense, but we don't see how this made sense in the past. And so when we now extrapolate this even further out in the market, right, and we say that now the market is super risk on because interest rates fall or because the Fed balance sheet is expanding, I don't really see any connection there. Even in the bond market that is 100% certain in terms of its future cash flows, we don't see the connection. There are other drivers that influence the prices, and they're not as theoretical, as abstract as people believe. I think prices are mainly determined simply just by the flavor of the day. I believe it's really that simple. It's just what's the current narrative of the day. If currently people are all worried about the solvency of the US government, then people will buy things like gold. If people are worried about the strength of the dollar because of the decoupling of the dollar and gold, then people will buy gold. If people are very optimistic, then they will buy, say, stocks or tech stocks even. There are too many things where the theory is completely in disagreement with what we actually observe in reality. And I believe that a good theory should somehow reflect reality. For example, let's talk about the following. Let's go back to this example. And let's say we compare two things. We first have our very stable company that simply just returns $1,000 every year, let's say in terms of dividends, right? It's still theoretical, but that's our company. Let's say it's Coca-Cola. And let's now work with another company that's slightly better. Let's say that other company can grow its cash flows by 3% every year, right? Let's say this is a growth stock. We still have to discount those future cash flows, but over time, that stock returns more and more dividends. Now, when we increase the interest rate, let's say we double it, then the value of our growth stock will plummet, in theory, to 12,404. So that's a drop of 42%, 42 to 43%. And let's go back to our stable stock. After the interest rate increase, it's worth $9,650. Before the interest rate increase, it was $15,333. So the stable stock only lost 37%. The growth stock loses more during interest rate hikes than the stable stock. Why is that? It's because the growth stocks, they increase their cash flows over time, right? And again, the value of an investment is the sum of all the future cash flows. If now a lot of the value of a stock is far out in the future, and then the interest rate rises, that means we have to discount all of that value of the future cash flows much, much more. The growth stock has to get more of its value discounted because more of the value is far out in the future. Interest rate increases are bad in theory for tech stocks. In an environment where interest rates go down, we should see tech stocks outperform a lot. In an environment where interest rates go up, we should see tech stocks crash. Now, do we see this in the data? Let us have a look. We keep our interest rates at the bottom, and at the top, instead of looking at long-term government bonds, we're going to look at the NASDAQ relative to the S&P 500. So you don't look just at the NASDAQ in points or at the S&P 500 in points. We look at its relative performance because that's what we are interested in. Now, again, In theory, what we should see is that this chart, the tech stock performance, should be going down when there is monetary tightening, when interest rates go up. Are tech stocks going down? The answer is, of course, no, right? We saw all of that monetary tightening. The tech stocks didn't care. We saw all of that loosening of the interest rates going down. We didn't really see much of a rally. We don't really see any connection between those variables, right? We saw this massive surprise crash in interest rates, and yes, it did help the tech stocks, but did we see before that, when there was tightening, how the tech stocks underperformed? We did not see that. We also didn't see any underperformance with this very, very quick tightening in 2022, 2023. The tech stocks rather tended to outperform again, right? Isn't that super surprising? From this point over here to this point over here, we should see tech stocks doing much, much worse. We haven't seen it. People that buy Nvidia, people that buy Google or Amazon, etc., are they really going to sell their stock practically just because interest rates are going up? Or are they going to buy more just because interest rates went down? No, this is not happening. The markets are not as efficient as the academics want to teach us. The reason why academics and university professors are not billionaires is because the theories don't work that well. It is, of course, interesting to think about these concepts, to think about these mechanisms, but it's super important not to overvalue them, to think that they are stronger than they actually are. There are very, very few people that decide to go risk on, that decide to buy Dogecoin just because the Federal Reserve has lowered interest rates or is planning to lower interest rates. It is not happening. Really, markets move very differently. Markets just move based on psychology. And yes, maybe these models can help us to get an anchor point. Does it potentially make sense, for example, to buy that property? What is the ROI that we get on this? What can we long-term expect compared to other investments from this? Yes, it does make sense to make these just as mental plays, but the vast majority of the return that will be made, even with a property investment, most of the time is, can we sell that darn thing after 10 years? If you bought a house far away from the city center and nobody wants to move there anymore, then that house will be pretty much worthless. Then all of those future cash flow projections are pretty much for nothing, right? You can now buy a house in Japan that's not in the city center, simply just a bit far out. You can buy a house now for the price of a car. This is definitely not what the older generation anticipated their investment to turn into. Now, let's have a look at interest rates versus inflation rates, because there's also these narratives around there, right? When inflation rates are high, when the Federal Reserve sees all of those high inflation rates, then they might increase interest rates, and when interest rates go up, that might be bad for the economy. And so when there's a high inflation rate reading somewhere, right, when the CPI suddenly is high, then maybe stocks could sell off on that day, right? This is normally how the market tends to react. But let's again have a look at this mechanism actually over time. Now, this analysis is not as clean compared to the bonds, right? Because again, for the bonds, we exactly know the future cash flows. What we're now looking at is something that can be argued with a bit more. So in green, we've got the officially measured inflation rate. In white, we've got the interest rate set by the Federal Reserve. And yes, there is some kind of a connection, but it's not 100% clean, right? We see how interest rates tended to be higher than inflation rates throughout the 1980s. That then potentially even continued up until the dot-com bubble. And since the dot-com bubble, we actually tend to see higher inflation rates than interest rates most of the time. Not right now, but most of the time. What we see at the bottom is a chart that you've probably not seen before. This is the S&P 500, but not just in US dollars, because that goes up over time. This is the S&P 500 relative to the money supply. So how much does the S&P 500 give us really in real terms after we take away the money printer? Now, what we might expect is that when the interest rate is higher than the inflation rate, that we've got monetary tightening, right? Through all of those years, it was very, very expensive to borrow money, and the inflation rate was pretty low. So it might make sense to avoid credit at all costs. But what we see is that during this time period, the S&P 500 outperformed monetary expansion. Isn't that interesting? Then we had our dot-com crash, then we had the global financial crisis, and nothing really significant happened in relation to interest rates and inflation rates. And then we had a phase of zero interest rates for a while, and this was good for stocks, kind of makes sense. But now that we see tightening again, right, since Q1 of 2023, we've got higher interest rates than inflation rates. We don't see stocks going down relative to monetary expansion. We should expect that now taking credit is still rather expensive, that there is real positive interest rates, that it does cost real money to borrow money. And so why aren't stocks coming down relative to the money supply? Why didn't they come down over here? It all does not make sense. It all does not add up. All those financial models, they sound very smart, but really when taken into practice, really when trying to apply this in the real world, it is not really a profitable way to approach markets. Now, here's what I take from all of this. I think there is way too much noise in the financial literature. There's way too much noise in financial publications. If people talk about interest rates and about inflation rates and about projections about the economy, etc., all of those things really don't matter that much. What matters instead is, where is the zeitgeist going? What do people actually want to buy? People do not want to buy bonds anymore, right? People got sold bonds in the early days as a retirement thing. But now over time, over the decades, people learned that those bonds don't return anything real, that the returns from bonds usually are lower than the monetary expansion. We then saw more and more people moving over to stocks, which makes sense. But then now that's not even enough. People went into tech stocks, and then that didn't become enough and people went into crypto. So then over time, probably that's the reason, because of the expanding wealth gap, it gets harder and harder for the middle class to keep up. And so they're simply just willing to take on more and more risk just to catch up to a degree. People are not buying Dogecoin because they now want to gamble much more. It's simply just way harder now to get the money for the down payment on a house, right? And so you have to take on a bit more risk in order to get somewhere and not to get totally left behind. That's probably why. We can't just have a 9-to-5 corporate job and save in bonds and then finance an entire family on just, say, one income throughout the decades, right? It's not working anymore. It's simply just too competitive nowadays. And so in the end, that makes investing easier, but also harder. It makes it easier in the way that it's actually less theoretical than people make it to be. I don't think that all of this technical mumbo jumbo with discounted cash flows and with yield curves, etc., and with interest rate projections, I don't think that they really matter that much. If you hear people talk about this, I think it is completely legitimate to just dismiss this. Again, we see this in the data, right? There is not too much of a connection. Why take it too much into account then? So that makes things easier. What makes it harder, though, is that we now have to become trend spotters, right? We have to figure out what the masses are likely going to want to invest in, say, 5 to 10 years from now. So, for example, as a trend, right? This is how I see this. Let's say we see more and more division of the wealthy and the not so wealthy, and the not so wealthy cannot afford anymore to have a large family. Maybe a lot of people stay single. That means when we buy property, we probably should not buy the suburban house. We probably should rather bet on small units, small studio units, maybe in the city center. Or let's say when we think about discretionary spending in 10 or 15 years, right? Will this all go into, say, amusement parks, right? Disneyland, etc.? Or is this more likely to go into things that singles might enjoy? I believe that the ratio of discretionary spending that goes towards online purchases at home is likely going to go up compared to discretionary spending for amusement parks, for example, right? Simply because of these long-term trends. And we don't even have to look that far out in the future, right? This can also be played a bit in the micro scale. For example, the Zoom stock went up during COVID. Everybody thought that we're going to work from home, and to a degree we do, but in the end, of course, there is competition for Zoom as well. A lot of companies shot up during COVID that then afterwards went down. We just have to look at what are currently the trends and jump on them early enough. This is, I believe, how we make money. There's no need to overcomplicate things. We simply have to try to look ahead. We have have to try to become trend spotters to a degree. This, I believe, the way to make money. I'm sharing what kind of trends I bet on in the premium membership of this channel. It's down below, thebitcoinstrade.com. There's an introductory video of 7 minutes. If you've got a few $1,000s to invest, it might make sense to have a look at it. There's also a 1-week money back guarantee. So in case you don't like premium, just message me within the first 7 days and I will refund you 100%. If you got some value out of this video, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you in the next video or see you in premium. Cheers.